And is that Lindsay? Hey.
How are you doing?
Good. How you doing?
Good. Perfect. Awesome. Thank you.
Kenzie, what do you want to get out of this today? What's your goal?
I have a lot of buyers that's kind of the feedback I get from them.
Just the holdback is the credit.
Oh, my credit's so bad, and
Yep.
I don't have a down payment, and
Yeah.
I really want to bring back value and have a good response.
I just want you to see your direction.
I'm gonna suck it in now that I can see that.
And then once
We're in the same boat. We have clients that come to see us and they're not quite ready, so I totally get that. We can't do any business with them until they have something to offer on credit. Well, I'm gonna figure, hey Megan, be a couple stragglers, so I was just had a couple kind of intro points, but one thing I would like is if anything that goes on causes you to have a question, just jump up and ask a question, because it's more interesting if we interact rather than if I just do the whole thing off of whatever I've written down in advance. And Maria's gonna jump in whenever she thinks I forgot something or has something really awesome to say, so.
I always have something awesome. So.
You know, just kind of real quick, I own Black Diamond Mortgage. Maria's operations manager, and she works on pretty much all the business that goes through Black Diamond Mortgage. Danelle Connors in the back there, she's a loan officer at Black Diamond Mortgage. And basically, we are always looking at people's credit and trying to help them figure out how to get a loan. And so a lot of you are in the real estate, so obviously you have clients that want to buy a house and they're, you know, this is like an obstacle to getting the house purchase accomplished. And so goal is just to kind of get some fundamentals and some solutions. And it's complicated, kind of like a mortgage is complicated, so you won't get all the answers, but just some fundamentals. So something I thought I'd bring up is, do you guys like the Olympics? Anybody watching the Olympics? I'm like an Olympics addict, so right now I'm sleep deprived because everything is going on that I'm interested in at like 11 o'clock at night. So last night I was watching Michaela Schifrin. Did anybody watch that last night? I was a ski racer growing up, and so I spent my whole life from like age 8 to 20, you know, wanting to make it to the Olympics. You know, I was never as good as Michaela Schifrin, but that was my goal. And so watching her win last night, to me, was just amazing, and I just want to like equate it to this credit scoring class. So Michaela Schifrin just demonstrated last night that in the world of credit, if ski racing were credit, she's got an 830 credit score. So like she spent her whole life doing everything exactly the way she was supposed to do, and culminated at the moment where she can get a gold medal in the Olympics and beat all the other people that are trying to do exactly what she was trying to do the best, you know. So the credit score is your reflection of your ability to do everything perfectly, and then it's like on down from there. And so, you know, creditors are kind of looking at your credit score to be like, hey, can you just kind of tell me, does this person pay their bills? And that score is just like a one-off, you know, okay, they do or they don't based on that number that they arbitrarily handed you. So, you know, Michaela Schifrin, she trained every day, she did everything perfectly, won the Olympics, and so if she had a credit score, her credit score would say that if you want Michaela Schifrin to ski down a race course, she's going to do everything exactly the way she's supposed to, perfectly. That's what you can count on about her, as evidenced by her gold medal in the Olympics. And then in credit scoring, an 830 is a gold medal. Like, we don't see that very often. Just real quick, while I'm hitting that, maybe you don't even know this, but there's different credit scoring models. So there's, if you go into a car dealer, they might say that the best credit score is like a 900. And then you go to the mortgage guy and he's like, you cannot get better than 830. They're using two totally different scoring models. So just, when you hear the numbers batted around, the mortgage people, we use the most conservative version of credit reporting. So it's usually a lower number. So if somebody's been into a car dealer and they got a score, and they go to the mortgage guy and it's 50 points lower, it's because it is 50 points lower. The mortgage guys or the mortgage gals, we're using a different system. So it's more conservative. And the car dealers they're actually giving out a lot more loans than we are. Their system, you look better over there. So.
And I just have a point
Go
to add
ahead.
to that. So social media people, if you're or on Facebook or whatever, you've heard about social media algorithms. It's the same exact thing. They use a different calculation, and so it may not be called algorithms, but it's the same concept. So they take it's a different way to structure how the credit score is taken. And then also to pinpoint on what you had said prior to that, how I explain it to my kids when you're looking at credit scores is when they start school. When you start school, beginning of September, your grade is 100%. You have an A. The downside to that is it's harder to, when you drop below that A, it's harder to get back up, but it's easier to keep the A, right? So I always try to talk to my kids about that is, it's easier to keep that 100, but as soon as you get down to that B and C, it's harder to get back up. And that's actually the illustration that we want you to just think about as we're talking about credit scores and this whole morning.
Awesome. That was actually we talked about that yesterday. We call that at our house the Beckwith Principle. There's a teacher at Whitefish Middle School, and I don't know him at all, but my daughter was in his class, and Mr. Beckwith, his standard is you have to show up on time, you got to keep everything in your notebook, and you got to do exactly what he says, and you get 100%. And then anytime you don't do that, you get a lower grade. And all of her other classes, you do math well and you get an A, and then you get another opportunity to get an A. In Mr. Beckwith's class, you start out with 100%, and then it just kind of goes, you either stay there or it goes down from there. But there's no doing really well on the test. It's just doing exactly what Mr. Beckwith says. So that 100% principle is something we thought was good for credit scoring, because you have an 830 until you don't. And then it's like you spend the rest of your life trying to get back up there. But you only have that 830 at the very beginning of the relationship of credit if you ever get there. And then it's like you got to stay there, you got to work hard. And then if you end up getting knocked down, you spend a long time getting back up, because now there's information that tells everyone that you didn't do everything perfectly. And so the Beckwith Principle is good. One thing that I wanted to mention, just when you think about credit, we're going to go over how to deal with all the problems of credit, but the principle is basically you need to adopt in your mind. Justin does this a lot in his things, talk about a mindset. How do you get things to go the right way in your life if you want to make more sales in real estate or whatever? In credit, you need to adopt a mindset to be successful with credit, ultimately, that everything's your responsibility. There is nothing that is the creditor's fault. Now, we can all argue about that all day long, but that credit report disagrees with you. So the credit report says anything that goes wrong is your problem. You need to fix it. So to be successful with credit is to take 100% responsibility for everything that goes on. And so we're going to go over what do you do if you made some mistakes? How do you get out of that situation? But also you need to adopt a zero tolerance mentality with credit mistakes. So that means if you go into the hospital and they're throwing bills around and you don't know what's going on, you need to find out, because it's going to show up on your credit report. So basically, if you incurred a whole bunch of debt and people gave you money and it's your responsibility to pay it back, and even if they do a terrible job of getting back to you by mailing you a bill or sending you something, guess what? On the credit report, that was your fault. And so that's the way the world works, and that's a whole nother discussion about whether that's a good thing. But when you go into any creditor and they say, well, do you like to pay your bills on time? They're going to pull up the laundry list of your life, and they're going to take a look at it, and if you didn't pay a bill back, the next thing they're going to ask, well, what happened here? And you're like, oh, I didn't mail me the thing, or I got in an argument, or the funny one, I hear this one, is I was so mad at Verizon, or we'll pick on AT&T, doesn't matter, but I just gave them the phone back and said, you guys take this thing, I'm out of here. And then they go in to get a mortgage a couple years later, you're like, well, what's that? Well, those guys, they were overbilling me, and they were blah, blah, blah. It's like, okay, but there it is. Now your score's down, and you owe them $1,000, and so the zero tolerance policy is huge. You need to adopt a mindset that, I'm gonna be responsible for everything. If I gotta go fight a war with that creditor, try to do it before they put the bad information on your credit report, because it's easier to take care of it before it ends up on that credit report than it is after it ends up on the credit report. So once you, let's say you have bad credit right now, today start a zero tolerance mindset and start working that direction, and then the rest of it's going to clean up over time eventually. So that's a huge thing. It's very hard because, quite frankly, you might have been wrong. Kenzie, go ahead.
Yeah, I work customer service at the bank, and I can't tell you how many people made mistakes just because they weren't aware of things, or because they try and beat the system. Like, oh, I thought my paycheck would come in before I wrote that check, and it's like, hey, that's not bank error. You're the leader of your account, and so it's really try and grab any information that you can. If you are the expert, and like you said, you have the accountability, and you know what to expect.
Cool, yeah. So Kenzie's pointing out do you work at a bank right now? Or?
No.
Okay, she's worked at a bank before. The mindset of the bank is what? Basically, they want to be nice, but whose fault is it? The customer, right? They'll try to help, but if you didn't do, you're in charge of all this stuff. This is your problem, So adopt it's my problem. Now you got, real quick, you got 3 different companies who's been given the task of paying attention to what you do. So there's Equifax, TransUnion, and Experian. These are 3 different companies, and they do this, and they each give you your own score. Some creditors will just look at one of them, and they'll issue their loan decision off of one. Some will look at 3 and use the middle. In the mortgage business that I own, we do all 3, and then we look at the middle. And then there are some that just look at one. You can pick, either option can be good or bad, because if the one's the low one, you'd wish you had the middle one. We like to look at 3 because all of our lenders are like, give us the biggest picture you can on the borrower, that's what we want to see. But bottom line is you can have a problem with 2 and a great situation with 1, and that's good that you got the good situation with the 1, but you need at least 2 of them to be saying good things about you at our office to get a great credit report that we can work with. So when you're dealing with a problem, guess what? The problem could exist in 3 different places after you made a mistake with 1 creditor. So you make a mistake with 1 creditor, now it may be at 3 different places, and the remedy is all 3 of those guys. So you go to Equifax and you argue with them and you get it straightened out. If you only do those guys and the other 2 know about it, you have not fixed the problem. You've only sort of fixed the problem. So that's where the complicated stuff gets in. But you got 3 bureaus. So real quick, here's what we're going to go over. And I've got an expert on this that's going to, we're hoping the technology works, but he's going to hopefully show up here. And he's in Los Angeles, but is Ryan on there right now? We don't have to page him in yet, but is he watching? Can you tell?
I can in just a minute.
Okay, well, we'll see if let me know if you think he is on.
He's not yet.
We did a test last night, so we think it'll work. But anyway, I want to go over, it's in your little folder there. Does everybody have a Black Diamond Mortgage folder? If you don't, we can get you one. But I want to give you a couple examples of the cost of having bad credit as comparison to good credit. I want to go over kind of 3 major categories of what credit, what kind of credit do you have. I want to address the number 1 issue. I kind of addressed it, is that zero tolerance policy, but it's you need to know the accurate story of your life. Don't be relying on other people to know the best version of your situation. You need to know. Kind of like balancing a checkbook. You go down to the bank, and it's your job to know how much money you have in your account because there's stuff coming in they don't even know about. So having accurate information. We're going to go over, this is the big one, and if you're wanting to help anybody that's got credit stuff, what do you do if you have bad credit? How do you remedy that situation? And there's a couple different angles. There's going to be Ryan's going to be talking about when we send a referral to him to fix somebody's credit score, he's really focused on getting that score up because we asked him to. We said, hey, we need this person to come back to us with a 640 credit score. That's your mission. Then there's other things like just getting them to report the information accurately. And then there's say I'm a mortgage company and I'm going to give you a loan and you have poor credit. Why am I going to give you a loan? I got to have a reason. I'm not gonna give you a loan if the only story is you have bad credit. So if you're gonna have bad credit and you're gonna get a loan, what's the workaround? So we're gonna go over that, and then a few technical things. So that's kind of our outline. So I was brainstorming with Maria, some like just, what, you have bad credit, what does that do to you? So just to kind of create some easy, does anybody have a calculator on their phone that can do an easy math problem? Justin's got one? Okay, so let me give you a couple easy math problems. They're relatively easy. But what is 2% of 200,000? You can probably do it in your head, but we're on your calculator. 4,000. Okay, so just easy numbers. But if you come in and get a conventional mortgage and your credit's bad, and I'm able to get you one, you could be paying as much as 2% higher interest rate on a $200,000 mortgage than somebody who has great credit. I mean, I'm talking like a pretty bad credit score. We're able to like get you a loan anyway. You should have been told no, but we work our mortgage broker magic. We get you a yes, but the cost is higher interest rate. Okay, so you get in and you got your $200,000 every year. You get to pay $4,000 more dollars than everybody else who's got good credit. So that's expensive. Now you have a house, and there's some positive things going on, but right out of the gate, like your cost of entry is different than the other people's. Yeah. Same with cars, I'm gonna pick on car dealers because they drive me crazy, but they give everybody loans. Doesn't matter how bad it is, you get a loan, right? But they don't treat everybody the same, So if you go into the place and the car dealer's just like, how's your credit? And they run it, a whole bunch of times, like, whoa, but they wanna make a sale, they're gonna give you a payment. They're not even gonna talk about your interest rate. Like, here's your payment. And so anyway, that payment could be, like I might be able to go in if I have great credit, I might be able to get like a 3% car interest rate. And a person that has kind of like a train wreck credit situation, they get to go get a car too, but their interest rate's like 8%. So we saw 2% on 200,000 costs a lot, but also 4 and 5% differentials on car loan. It's going to cost you. So if you got the car and you got the house, you're getting up to, now you're getting up to 4,000, 5,000, 6,000 of your annual budget is being eaten up by this credit situation. Guess what else happens? What do you get to buy when your credit's not as good? So like let's say you're out looking for a car and you don't have good credit and you go to the premium dealer and they turn you down, but you go to the dealer that'll kind of work with you, or we don't either. I think I've heard one say, you're approved by walking onto the lot. I've heard this here in the valley, but okay. So let's say you go to those guys, and maybe you need a car that bad, but what kind of terms are you going to get there, and then what kind of car are you going to get? Like, if they have kind of a lemon, and you need a car really bad, you might take that car, drive out the lot, and then you might have a future problem coming. You bought a lemon, and why did you buy the lemon? Because your credit wasn't very good. So all these financial cost-adding implications due to the credit. Okay, here's another one. So let me just give you an illustration of my personal situation. But when I was 23, it was 1998, a long time ago. I bought a house in Whitefish. It was a 2-bed, 1-bath. So Justin, what did I pay for my 2-bed, 1-bath house in 1998? Just guess. Real estate business.
Wow. 98?
Yeah, 98. Or any realtor in the room want to guess?
79.
That's exactly what I paid.
79?
$79,000. Yeah.
Right.
So Whitefish, 2-bed, 1-bath house on a lot in the city of Whitefish, 1998, $79,000.
Wow.
At that time, I was able to get a loan. Let's say I couldn't get a loan because I had just gotten out of college. I was like, woo, just whatever, right? And then all of a sudden, I go into the mortgage guy. He's like, no, Dave, you need to fix your credit. So I gotta wait a decade or 2 decades. So here we are, 2 decades later. What is my house worth?
280. Yeah, 300.
How much equity did I earn by getting in 20 years? $200,000. So what could it cost to just train wreck your credit for 2 decades? It could cost you $200,000.
Right.
Same exact house. You go in and buy it. 2 decades later. The cost of money's a little better now. I had an 8% interest rate back in 1998, but But anyway, my payment was like $500, you know, and so the cost, inflation is a big cost. So while you're getting your credit and you're dealing with a less than perfect car and you're paying extra in interest, maybe you're not even getting stuff, so the cost is higher down the road. There's fees and things that go along with bad credit. So when you're, you mentioned at the bank, when they call and say they didn't know about anything, what else happens, Kenzie?
They kind of displace blame, or
But do they charge a fee if they?
oh yeah.
Yeah, fees, right?
That's why they're calling.
Yeah, I mean the banks. I've heard that banks make a lot of money just on these like fees, the bad check fees and the whatever fees. So while you're dealing with all the drama, it's like here you're paying these $25 transaction fees on $10 checks, and you know it could be really expensive. So that adds up in addition to the other things. And I kind of mentioned this on the car, but when your credit's not good, what you can buy is dependent on the sellers that are going to work with somebody with bad credit. You know, like you don't get to pick from everything when your credit's not good. When your credit's good, you get the pick of everything. When your credit's not good, now you're limited. So there's cost associated with that because there's long-term cost. All these costs add up. So obviously we don't want to have this kind of credit, right?
I have a quick
Go ahead.
example that I just experienced. I have an acquaintance, because if I say too much more, then you guys can go on my Facebook and probably find out who it is. I have an acquaintance that actually, his truck broke down, and he pretty much drove from south of Kalispell all the way down to Isinger, barely. Like he barely made it to Kalispell, so he had to get a vehicle. Well, this gentleman is 6'2", very big guy, and he really needs a truck because the vehicle that was breaking was his truck. Well, he got a brand new car, but it is about this big. It can fit in the bed of my truck, and but it's brand new. But it's the only thing that he could get, and his goal is to hope, you know, that he can work up his credit and maybe get a truck someday. But I look at this gentleman, and he might be stuck in that car for a really long time, and it's just not him. So it's. But yeah, it's his credit, and it just kind of sucks. So, but that just happened last week. So.
I bet everybody's got an example, right? And that's a good one. The car one's probably the one we can all relate to because you got to have a car, whether you have good credit or not. You know. So 3 major categories of what is your credit like. So that's the next page on here, or page 3, if you're following along. But this is just something I came up with. I mean, it's very simple, but I look at credit as 3 different categories. You can't get a loan right now with the exception of the car dealer. But if you're in the mortgage office and you're trying to get a mortgage, there's a group of people that I cannot get a mortgage for them. Their credit's too bad. There's people that have not that good at credit, but I can get them a loan, but it's going to cost them a little extra. They got to like take the higher terms, they can get a mortgage. And then there's good credit. So you got these 3 credit groups. And everybody wants to be in the good credit group, but a lot of people are in these other 2. So, as I mentioned, a few examples. If you're in the unlendable category and you come into like a legitimate mortgage institution, then the only loans you're going to be able to get are what I would call predatory or hard money loans. You know, like somebody who's just going to lend you on any factor other than your credit. So they might look at the house and go, it's worth a lot. I'll tell you what, I'll throw you in a loan. If it doesn't work out with you making payments, I'm just going to take the house from you. You know? Or the car or whatever. And then, so these hard money loans or these private, these are loans that are short term, very undesirable, and the reason you probably shouldn't do this like ever, but if you get into one, you probably have a way out, otherwise you shouldn't be doing it. So some people get into it and they're like, yeah, they know in 2 years life's going to be better, so they're willing to enter into these crazy terms. We don't do those kind of loans at Black Diamond Mortgage, but I'm aware of them, and I can even, like, if somebody's like desperate and they need a loan or they're going to lose their house, I've got a few people I can call them and they'll do one of these, you know, and they're basically rich people that have money, and they're like, well, I can charge really high rates and deal with these problems, you know. Then the weak, poor credit borrower, there are some loan programs that are actually designed to help people that have tough situations, but they're going to reflect the fact that it's a riskier loan. So there's going to be rates higher, there's going to be like extra mortgage insurance, so there's going to be like things to protect the lender from making this loan in the first place. And that's, and then good credit, you get great terms, life is good for you. So what's like unlendable? I mean, unlendable can be, yesterday you just filed bankruptcy. Okay, so like, maybe you need to wait a little bit. But I mean, there's people who might touch a loan like that, but I mean, it's like, that's typically a cooling down period. Foreclosure yesterday, again, it's like, okay, your credit just got annihilated. Probably if you pull credit a month after a major event like that, it's going to be a low score. There's going to be a lot of bad information on there. You're probably not lendable right now. You just wrote off everything, so maybe you didn't go bankruptcy, maybe you didn't foreclose, but you just walked on the Verizon bill and the medical bill and you just basically quit answering your mail. That's one of our jokes in the office is I'll pull a credit report every once in a while. I'm like, this person does not open their mail when it arrives at their house. I'm like, there's no way. This information, because sometimes the borrower is saying, I don't know. And I'm like, I think they're trying to reach you,
And they lived at the same address for
Yeah, and they
10
lived at the same
years.
address for 10 years, so it's like, okay. So anyway, that's unlendable. Weak or poor credit, it's like, this is like one that we try to help these people and like see if we can get it figured out. But basically that's like, I missed some payments, but other than that, I make my payments. So I had a bunch of bad experiences and then I got over it. Or I went through bankruptcy 2 years ago. A lot of the government-backed loans will be like, okay, 2 years, let's see if you can do it now. Or foreclosure, a lot of them are 3 years, let's see if you can do it now. And we'll touch on that a little more specifically a little bit later. Those are going to be our little technicals. But and then collections, stuff goes into collection, gets written off. You threw the Verizon phone back at the Verizon dealer. Well, a couple years later, it'll eventually get written off, and but your credit score is going to reflect that. It's not going to be as good. So, a big principle that I just wanted to highlight today is, and I mentioned it at the beginning. Whatever's been going on, there needs to be a firewall moment in your life. So you're going to like, okay, drawing a line in the sand. This is going to stop, and I'm going to start doing it the right way. So that has to happen. And it's huge because like you could get your credit down to 600, write off stuff, a whole bunch of horrible things happen, and then you go, okay, I'm gonna start doing it right. You go 6 months down the road, and then you miss another one. You're gonna be right back at the exact same place you were when you started the 6 month journey. That's how credit works, unfortunately. Like when you start the recovery process, the credit scoring model is designed, as far as I can tell by looking at it, to specifically put you right back down as soon as you mix another payment. So the only way you're getting out of there is repeated good behavior. You have a question, go ahead.
Is it true that you have 30 days to let it fix your credit after if you miss a credit card payment?
That's awesome. Let's go over that real quick. A little technical, and let me know when Ryan gets on.
Yeah, he's a few more minutes, he said.
Okay. So the thing that typically is reported on the credit report is called the 30-day late. So that's awesome that you brought that up because you can miss your payment and it's not showing up there for the most part until 30 days have gone by. So let's go over that. This is huge. Okay, so you miss let's say your mortgage payment. The mortgage, as far as I'm concerned, that's the thing. Don't miss a mortgage payment. But let's say the first of the month comes up. It's due every month on the first. You can't make it. What do? Does everybody remember 2008? I do. It's like vivid. It's like the worst time of my life financially. So I remember being so poor one month, waiting on commissions and not having very many. And I was like, first of the month shows up, and I'm like, I can't do it. I can't make a mortgage payment. But I've never missed a payment in my life. I called my mortgage company, though, and I said, hey, when do you report it to the credit bureau? Day 30. I said, okay, I'm going to call you on the 29th. I'm going to make this payment. I don't know how I'm going to make it right now, but I 29-day countdown, and I did. I called them on the 29th, pulled it out of my checking account. I did not have a late payment. So I've never made a late payment, but I was 29 days from the due date. So huge, and it's like if you can avoid we just had a client the other day. It was devastating. I just felt so bad for the guy. He had 2 31-day lates. And there's nothing I can do for him. He's explaining it to me. He's like, I was trying to get to the bank, and I was trying to call, and I'm like, so how many days was it? We're counting them off on the calendar. We're like, yeah, it keeps coming up to 31. And he's like, yeah. I'm like, it's called a 30-day late. And I was even Googling it. I was like, so what is a 30-day late? Because some months have 31 days in them. 30-day lates, a 30-day late if they think it's 30 days late, and now you have a 30-day late.
So
Some of them might give you the 1 day, but it's at their discretion.
So a mortgage has a 15-day grace period. So is it
Yeah.
30 days from day one?
That has nothing to do with credit reporting. So what that is they can charge you a fee for being late at day 15, and that fee is legitimate,
Right.
but they're going to report you late at day 30.
Okay.
So you can pay those 15-day late fees all day long, every month if you want, and be a timely mortgage payer. You just have to pay
The extra.
$50 or whatever they charge you
Yeah.
for being late.
So if you pay your mortgage on the 16th, you're paying a fee.
But you're still good.
You're not getting dinged on credit.
But watch this. Those fees, like, they can get you into trouble. So we have a loan we were just working on yesterday, and this person paid off a loan in its entirety. But somehow, because of the way they did it, the time of the month or whatever, there was a lagging $20 fee. And they paid off, like, let's just call it $100,000. I'm just gonna make this stuff up. They paid $100,000. Close the account, please. Well, daily interest, yada yada. There's $20 left on there. They're like, "Woo, we're done with that thing." Well, 30-day late shows up. They're like, "What happened? We didn't know about that." So remember, what I say at the beginning of the class about whose responsibility is that $20? They have a 30-day late on their mortgage payment. They just mailed them $100,000. It's their fault, and they missed the mortgage payment.
Wow.
And then we have a nice letter. They explain they didn't know, and nobody cares, right? Unfortunately, they have a 30-day late on their credit. They cannot get it off of their credit report. It's a legitimate 30-day late. So.
And I just want to mention, I was just going to mention really quick, the gentleman that he's talking about, we do have a lender that actually counted the way, because it was back in November, counted it as, it was paid on December 1st, so that's okay. I'm going to count that. But then we were running the scenario, and it was like an 8% rate for this gentleman, so it wasn't even worth it. It was like, This is not going to save you anything.
We had a loan for him if he was one of these people that makes late mortgage payments, but it was a horrible loan. And so like, by the time he made it through where we concluded that he had late payments, our lender's like, well, you can do this. We call it the fresh start. And anyway, instead of getting like a 4% rate, it's an 8% rate. We're like, let's just stop. Don't get a loan right now, So go ahead.
Does everything reset after, or things fall off after 7 years? Is that true?
Generally, hold that one for Ryan, because
Okay.
he's the guru, and I don't want to get that wrong. But what I view credit reports like a 7 to 10 year laundry list of everything you've done. And the dropping off part is going to be interesting. I want you to hear Ryan's take on that.
Okay.
But I'll just tell you one little bummer about that. How many of you seen your creditor sell the debt to another creditor?
Mm-hmm. Yeah.
Start the calendar over. Brutal, right? So if a new creditor picks it up, it's now theirs. They get to sit on it and report it to the credit bureaus for 7 years. So you think creditors probably know about this, right? So when they get to a certain point, they might sell it to another creditor so that it doesn't drop off. Big principle here, and then I'm going to see how we're doing with Ryan. But so I met at the beginning, but you need to know everything about yourself. Okay, so get the information. So at least once a year, the government has made it mandatory legally. You can go on and get a free credit report without the score. You want the score, but at least the free credit report will tell you if you got late and all that kind of stuff. And you got to get it from all three bureaus to know your situation. If you guys go to do this, let me just warn you, they are going to try to sell you stuff like you can't believe. You do not have to pay. So if you're paying, you're now engaging the wrong way. Like, so when you go to get your free credit report, try to do this. It's free. And there's a company called freecreditreport.com. They're not free. They just own the web domain called freecreditreport.com. So go to just Google annual credit report and then carefully go to the 3 credit bureaus. And when you get to those credit card enter things, you're doing it wrong. So like walk back 2 steps and figure it out. And then you can get a copy of all 3 credit bureau reports without your score. But you can see if there's something on there for free. The other thing you do is just go apply for a mortgage. Like, I mean, I love sitting with people and going over their financial picture because eventually I might be able to sell them a mortgage. So even if you got horrible credit, get a mortgage broker to pull your credit, and they're going to tell you right out of the gate. They're like, okay, well, I can't give you a loan because of boom, boom, boom. There you go. There's your laundry list. Let's start working on it. So, and then that's the actual one that they're going to use. Some of these other sites, Credit Karma, there's blah blah blah. The people come in and bring this stuff to me, and it doesn't look like our credit reports.
Right.
So it's data. It's probably helpful, but it's not necessarily. What's up?
He's on. We just had to rotate the camera.
He's on. Okay.
Yeah.
All right. We'll see if we can get him up there. And I'll keep rambling. And then I'm going to get one more thing in, and then we're going to jump to let Ryan do some talking. And we'll ask him that one question, and I want you guys to ask him other questions. But if you've made mistakes, your credit's bad, and you're going to try to get a loan, simple thing here, but I want you guys to know this. This is the standard verbiage, and it's in. You don't even have to write it down. It's on. It says here what a creditor needs to loan somebody who's made a mistake. So this is if you write an explanation to a lender, you're like, hey, you made a mistake. Why did you make that mistake? There's only one reason. Okay, if you give them any, people will write me these 4-page reasons for why they made a mistake. No, there's only 3 things you need to tell me for me to get over it. So this problem will stop happening. I have to know that. If you can do it again, no loan for you. Okay, so whatever it is, explain to me why it stopped. Okay. Number 2, hopefully, although this is rarely the case, but we like to do our best for you. It wasn't your fault. It just happened to you. So like with the medical bill, it's generally accepted that it happened to you because we think all the hospitals just do that to people. But the reality is, if you can convey that it was something that was not your fault, that's awesome. Because then that would explain you wouldn't do this normally, right? So that's a great explanation. But if it was your fault, somehow convince us that you get that volume to go off.
Yeah.
Okay. So somehow convince us that it was an isolated incident. Okay, so like you know, if you go through bankruptcy, maybe all this stuff happened and you lost your job and all that, and now you have a job and you're employed. So it was an isolated. It was like back then I didn't have a job and I lost everything. Now I have a job. I can pay my bills now. Okay, that was back then. We're good, you know. And then they want to know this is not likely to continue. So again, for the lender to give you a loan, if you missed payments and have problems, these 3 things are mandatory. And so like when borrowers will have to write us a letter, we'll sometimes send it back to them and go, because they'll say, well, this creditor was a jerk, and I couldn't get a return my correspondence, and like, no, you're engaging a new relationship with a creditor. They want to know that you take responsibility for everything. So anyway, these 3 things, if you're coming out of bad credit, that has to be your story. So either it is your story or you need to get it to be your story however you can. That's the way out of the situation. We got Ryan here. I'm going to introduce you real quick, Ryan. I don't know what the delay is going to be like.
Can you hear us okay, Ryan?
Testing. Can you guys hear me now?
Well, hold on. There's
Okay.
going to be a delay that I have to turn on.
I'm going to introduce him real quick, and we'll see if we can get the start of the universe to line up. So I've been doing mortgages for 12 years, and I have people come in and they say, I pulled our credit, and it's like, you know, not good enough to get the loan. And so what's the solution? You know, it's like I can sit down with you and go over everything I think is going to fix your credit, and then I send you out the door, and then you come back 6 months later, and you didn't do everything exactly the way I said, or I didn't tell it to you right, but your credit's still not good. So I'm like struggling. This is like an area of my business where I'm like, I'm not making money spending hours with people with bad credit, you know, and then like telling them what to do and having them come back a year later and they still have bad credit. So like that's just a lot of work for no. So I met a mortgage broker out of Billings, Montana. Can you hear me, Ryan?
I can hear you, buddy. Can you guys hear me?
Okay. Anyway, her name was Susie Redinger, and she introduced me to Ryan. She's just another mortgage broker, but she says you got to do this. So basically, you get the client, their credit's 580, and it needs to be 640. They hire these guys. They will send the client back to you when they've finally done everything they're supposed to do, and get their credit up to 640. And so I'm like, oh, this is great, you know. So what he does, his business is basically that business. Clients are contacting him, mostly it's the referral of realtors and mortgage brokers, and they're saying, you know, hey, I've got currently a 5 whatever credit score, I need a 640, and this is what the mortgage guy told me, and I want to, you know, what do I got to do to get this fixed? And we'll supply them with the credit report that we pulled, and then they will help this person get on the track to make it happen. And with that, maybe I'll just let Ryan, if you want to talk and introduce yourself, maybe explain that process a little bit.
Yeah, of course. No, and thank you for having me. Is the audio okay? Can you guys hear me? Yeah, of course. No, and thank you for having me. Is the audio okay?
Give us 1 sec.
Just a second. It might be louder on this.
I can hear the echo, like it's maybe delayed 10 seconds or something, but hopefully it's okay.
Can you guys hear that?
Yeah.
We're gonna make some adjustments.
We're going to improvise.
Yeah, you guys do your thing. I'll let me know when you want me to start rambling.
There, so watch him up there.
Start rambling.
Good. Okay. Well, I always like to start by asking a question. I kind of jumped on when Dave was getting into some of the annual credit report stuff and talking about errors on credit reports and that sort of thing. And one thing that should scare all of us that are in the room there is, you know, or any consumer for that matter, is that, you know, literally you guys, 80% of credit reports contain detrimental errors. So there was a study done by the Public Interest Research Group that said that 79% of every credit report contains detrimental errors that would keep them from being able to qualify for a home loan, an auto loan, those types of things, and are keeping people paying higher premiums on car insurance and homeowners and those types of things. So that's kind of the premise of where I developed this passion 12 years ago to get into this business. And I met Susie and I met Dave, you know, I don't know, maybe it was 7 or 8 years ago at this point, but it's been a while. I met Susie in 2008, I believe. So I've had a great relationship with Dave, I think, since about 2010. And I've worked with other folks at his team there over the years. So I really appreciate Dave giving me this opportunity to share what I know with you guys. And I'll check back in. Is everything okay on the audio? And
About as good as we can do. So.
Perfect. I'll try and yell a little louder if you need me to. It looks like some people are commenting on the Facebook Live that they can hear fine. So I want to take questions too. So Dave, Maria, if you guys can, if people are raising their hands in the room there, because I can only see Dave's pretty face from my angle here, make sure that they know that I'll take any questions.
How about we do this?
Oh yeah, that's perfect. Hey guys, it's a good looking room. So I know you guys, one thing I want to mention is Dave was talking about annual credit report. Now, annual credit report's a great resource, but as he mentioned, it only gives the information. It doesn't give necessarily the scores. Well, I always tell people when it comes to a real estate transaction of any sort, you don't necessarily want to get the scores from a consumer site or an online resource. And the reason I say that, you guys, is because when you do that, like how many of you guys in the room have had a client come to you, if you're involved in real estate or you yourself have checked, and you know your credit score from Credit Karma says it's like 785, and then you know you have a mortgage lender pull it and it's a 602 or something, and you don't even qualify.
There we go.
Okay.
Hold on. Okay,
When
we're
they fix internet connectivity, it'd be better. Imagine our world.
I'm back. Can you guys see me?
you're back. Yeah.
I'm here.
Sweet. We can see ya.
All right. What was the last thing you guys heard? Sorry for the technical difficulties.
People who check their annual credit report and their credit score is like a 700 or something, but then why is it different?
Yeah, and as Dave said, you don't get the scores, and I don't know if it timed out on my end or was it an issue on your end, just so if there's anything I can do to prevent it from happening again.
Something popped up on Dave's phone.
Oh, put that thing on airplane mode, Dave. So just so you guys know, yeah, so Credit Karma especially, if you get your score from Credit Karma or any of the online resources, or even from a car dealership, that's not necessarily your mortgage credit score. So mortgage brokers use what's called the FICO Classic 04, Fair Isaac version 2, and the FACTA score. Those are the only algorithms or models that are approved for home lending, right? That are approved through Fannie and Freddie and the folks who set the underwriting guidelines. So it's important to understand that, you guys. If a client or you yourself are interested in purchasing a investment property, and you get access to your credit report through Discover Card even, and Discover says your FICO score. We use FICO, which is what mortgage companies use. Well, FICO's lying to, or Discover rather, is lying to you, you guys. Discover uses what's called FICO 9, which is a new version of FICO, but mortgage companies are not using FICO 9. Mortgage companies, and if you look, and maybe Dave can show you guys a sample of kind of the top of the credit report where they show the scores, and it'll show Fair Isaac version 2, FICO Classic 04, and what's called FACTA 5.0. So those are the different models. So that's just kind of a premise that I want you guys to wrap your head around, is if you go to 100 places, you'll get 100 different scores. And I mean that, you don't, it's not, there's no consistency to it. There's literally, hundreds of different credit score algorithms or calculators. As Dave mentioned, annual credit report, yeah, you can get a free report every year, but they don't give you your scores for free. Well, I would argue that you don't want those scores anyway, because they're just made up, inflated numbers that are on some scale called the Vantage score, which nobody uses for mortgage lending purposes or any lending purposes for that matter. So why do you even want it? It's just I can tell you a number if you want to hear a number, but it's just made up. There's no relevance to it, right? So that's important to wrap your head around. Also, let's talk about collections, for instance. I know I mentioned 79% of credit reports have detrimental errors on them. Well, those errors are things like, someone goes through a bankruptcy and they had 20 accounts included in the Chapter 7 bankruptcy. They show 5 as included on the credit report. The other 15 shows active charge-off or collection accounts. You guys, in the 12 years I've been doing this, I've never seen a bankruptcy report accurately, ever. So just think about it like that. Think about medical bills. They're one of the most commonly misreported items. You could have a $35 medical copay that goes to collections, and the hospital or clinic, they'll write that off as a loss in their taxes. They'll sell it to ABC Collections, and then ABC will sell it to XYZ, and the same debt's on your report multiple times. Well, that's illegal under the Fair Credit Reporting Act, and if you know how to kind of frame the argument, you can have things like that corrected. So I know Dave said, there's things he can do with credit reports. But what I do when he says, hey, Ryan, I need you to look at this one, right? If you or Maria say, Ryan, I need your help with this one, what I'm going to look at is I'm going to look at the legality behind each event, right? I'm not going to argue that event took place. I'm not that guy. I'm not the guy who says, this isn't mine, I don't owe that never happened. An event can happen, but that doesn't mean that it's accurately being depicted on your credit report. And after all, the whole point of the credit scoring system, you guys, is to measure risk, right? It's to measure a consumer's ability to pay back a loan. And I think the system failed us based on the fact that I told you in the beginning that 80% of these reports contain errors, which should scare the hell out of all of us that are listening today. So when it comes to medical bills, sorry, I'm drinking my coffee. I'm an hour behind you guys. It's early on the West Coast. I'm in California at the moment. But so when it comes to medical, for instance, like I said, you guys, Dave or a mortgage lender may say, hey, we don't necessarily care about medical bills. Our underwriters don't care. They'll overlook them. But, there's an important distinction that I want to make is that, yeah, they may overlook them in the sense that you don't have to pay them. They don't need to be handled in order to qualify for the loan, but they still impact your credit score, right? So just because they say medical bills don't affect you, they do impact your credit score. So I want to talk about credit cards for a second. I want to talk about kind of how the credit score breaks down, and then I'll take some questions from you guys. When it comes to how the credit score is made up, right? We talked about why the score is different between different repositories or places that provide reports. But I also want you to know that, do you know why your credit score differs between the three bureaus? Why, when Dave pulls credit for a mortgage applicant, why do they have a 684 with TransUnion, a 690 with Equifax, and a 707 with Experian? Why? Does anyone in the room know why there's that discrepancy in the score?
Isn't it based off those algorithms?
Well, the algorithm is one of the reasons, because you heard me mention that they use FICO Classic 04, they use Fair Isaac version 2, and they use the FACTA score. But that's not the main reason, you guys. The main reason is that not all things report to all three credit bureaus, right? So, for instance, you could have a K Jewelers account, right? Like a smaller retailer, let's say, and they may choose to only report to TransUnion. TransUnion is typically the cheapest, the easiest to deal with. They're the smallest of the three bureaus. So if they choose to only report to TransUnion, that's saying it's a negative account, well, your TransUnion score is going to be significantly lower than your other two scores, right? So they're not required, creditors are not required to report to all three credit bureaus. They're only required to report to, nobody. They're not, they use it as an insurance policy. So they can choose to report to one or two, or they can report to all three. So that's why you get a discrepancy though in the scores. It's not, the algorithms are very, very close to one another. So it's not necessarily the algorithm that is causing the difference in the score. You'll see a 150-point difference between a TransUnion score and an Equifax score, for instance, and that's only because something is being reported to one of the bureaus that's not to the others. So I know I mentioned I'm in Southern California, so just a little bit about myself. I was born and raised in a little fishing village in northern Wisconsin, and then I moved to Colorado after college. So I lived in Denver, the Denver area, and really got into mountain sports while living there. And so I was there from 2004 to 2011. And while living in Denver, I was still driving my little Pontiac Grand Prix or whatever from college. And I said, I need a 4Runner. I need something with four-wheel drive, because I was going up and back from the mountains all the time and skiing. And so I went to the Toyota dealership, and they pulled my credit, and they only pulled TransUnion. And that score was a 638 or something like that. And I was just baffled, because I had just purchased a home and my middle score was in the high 700s. So how can my middle score be in the high 700s, but this Toyota dealership's telling me I have a low 600 score? Well, what I found out was, and many of you in the room probably know, that mortgage companies use what's called the middle score, right? So it's not an average, it's not a mean. It's, if you have a 700, a 699, and a 600, your middle score is 699. So it's the one that falls in the middle, literally. So they're not averaging it out. So I had those two high scores in the high 700s, but I had this one in the low sixes. And the reason I had that score where it was with TransUnion is because this slumlord I rented a property in college, and the slumlord reported a collection. This was around 2009, you guys, when I got this 4Runner, 2008, something like that, but it was right after the economy collapsed. And the slumlord turned all of his past tenants in for made-up collections. He said $411 for damages to a property. It was total fraud on his part. He was desperate for cash. And I fought it and got it off of there. But the point of why I'm telling you guys this is that small collection agency in Appleton, Wisconsin, was choosing only to pay to report to TransUnion. So remember that these companies that report, creditors have to have a monthly subscription. They have to pay to report data to the credit bureau. And they do it as an insurance policy because they want you as a consumer to understand that if you don't pay them, they can damage your credit score. Does that make sense? Do you see the bigger picture? So that's why you get the discrepancy in the score, you guys. It's not the algorithm, it's the way that the system is set up, and that not all things report to all 3 bureaus, and they're not required to. So, and you guys, if you have questions, just kind of raise your hand or fire away, and if someone up at the front can repeat it. So,
well, I want to know, you mentioned about how he kind of acts like a detective to find what's wrong with it. So if we have somebody come in and they've got a low credit score and I'm trying to help them get it up quickly, maybe he could explain that process of how do you find the opportunity to get the score up?
yeah, well, obviously there has to be a consultation involved because I have to understand the root cause of where the item came from. And then once I understand that, I do the legal research, which is, looking at Fair Credit Reporting Law, looking at the Fair Debt Collection Practices Act, the Fair Credit Billing Act. I'm looking at HIPAA laws when it comes to medical things. If it's an eviction or repossession, there's certain tactics that I can take by reviewing, the contract from the original lease or the auto deal that you set up prior to obviously getting the vehicle repoed. So there's a ton of things that I'll look at when assessing the situation, but I'm also looking at all the other, I know I mentioned kind of the components of the credit score. I'm looking at all the positive credit too, you guys, because the bad stuff is only 35% of your overall FICO score. The other 65% is, how are you managing positive open active credit? Obviously the 35% of payment history is late payments. It's public records like judgments or tax liens or bankruptcy. It's the collection stuff, the charge-offs. But the other 65% is, what are your balance to limit ratios on your credit cards? Have you had excessive credit inquiries? A lot of people think that you have this 30-day shopping window to pull your credit and it only counts as one inquiry. Well, that's not necessarily true, you guys. When it comes to inquiries only, they affect you based on how they're coded and who's pulling them, right? So Dave may pull my credit today and say, Ryan, your credit score is X, here's the type of loan I can do for you, or I'm trying to refinance, whatever it is. But when Dave pulls it, it affects my score 3 to 5 points for the first 90 days. And then if I'm like, I don't like the deal Dave gave me, and I go to Chase the home mortgage or whatever, and I go to Chase Bank and I say, Chase, you pull it. And Chase is using a different provider. Let's say Dave's using Troll Factual Data and Chase is using Equifax Mortgage Services. Well, they could be coded the same way, but if they're not pulled through the same provider, each inquiry is going to affect my score and impact me negatively. And this is why, like, when people go to a car dealership when they're in the home buying process, it can absolutely murder their credit score. So if you're in the process of wanting to purchase a home yourself, or you have a client that, if there's a real estate agent in the class here, if you have a client that wants to buy a house and you're driving around doing showings and they talk about getting a car, stop them, pump the brakes, do whatever, make sure they understand that if they go to a car dealership and they authorize the salesperson to pull your credit, what does he do? He goes back to the finance team and he says, let's figure out how to get this deal done. And they have 15 different affiliate banks that they work with, local credit unions, the big fish, Ally Financial, Capital One Auto Finance, blah, blah, blah. They run your credit, all 15 companies. I've seen people's credit scores go down by 80 points because they bought a car right before they bought a house, right? And again, there's this myth that, it's okay, you have a 30-day shopping window. Well, it's not true, you guys, because again, it has to be coded the same way, and autos are coded as leases, they're coded as auto loans, they're coded as consumer pulls, they're coded as miscellaneous. There's all sorts of ways to code them, and not every bank is going to code them the same way, right? Or use the same provider of reports. So while that myth is not necessarily a myth, there's truth to it that, yes, you can, there's a 30-day shopping window, but it only holds true if all the stars align, which they never do. So I don't even know why they tell people about it. It's just one of those things that is kind of funky with the credit system, and one of those things that gets kind of perpetuated like the game of telephone, but no one really truly understands what that even means, that there's a shopping window. But anyway, so I go off on tangents. I'm sorry, you guys, but I'm trying to get you as much information as I can in a short amount of time. So when I start talking about the components, sorry?
We have one question in the back.
Yeah.
Ma'am, did you have a question?
Yeah. So when companies say that it's won't affect your credit to go check your report, you know how they'll say that you can check it and it won't ding it. Is that true?
Yeah, that's a great question, and thank you for zooming in, Maria, or whoever's doing the camera work, so I could see the person asking the question. So, and that's a great question. There is truth to that. They're not necessarily lying to you. Now, I have heard stories that they do get lied to, but there is such thing as a soft inquiry, you guys. So like homeowners insurance policies, a lot of times they'll do a soft credit check. You know, there's certain things like certain rental applications where they can code it as a soft inquiry. There's account review inquiry. There's 3 types of inquiries. Let me just answer your question as fully as I can so you understand. There's hard inquiries, there's soft inquiries, and there's promotional inquiries. So a hard inquiry is when you're applying for something in exchange for that credit check, an auto loan, a recreational, be a 4-wheeler, whatever, right? Snowmobile. When you're applying for something in exchange for that credit check, that's a hard inquiry. Those are the ones that are set out to hurt you. And I think what Fair and Isaac were thinking about when they were writing these credit score algorithms, I think in their mindset was, we're going to punish people for inquiries to make sure that people don't overextend themselves. So we're just going to give them a few point ding so that people don't go and have everyone and their mother pull credit. Maybe that was their thinking at the time. So those hard inquiries affect you 3 to 5 points, but they have a diminishing impact over the first year or 2, right? So the first 90 days, they might hurt you 3-4 points. And then on day 91, it might hurt you 2 points. And then, after 6 months, they might be hurting you a point or half a point or something. So they do have a diminishing impact. So that's a hard inquiry. A soft inquiry is where it's coded like by an insurance company, or as your question, ma'am, as you asked, is where they just code it as you're not necessarily applying for something. It's more of a review, right? Sometimes like getting a cell phone coverage, but something like that, they may do like a soft inquiry where it doesn't ding you. I mentioned account review inquiries. Those are funny because that's like, let's say you have a Capital One credit card in your wallet.
Did you just say Capital?
Yeah, that wasn't a slip. I'll tell you why later if you really care why I say that. They're awful for a number of reasons. But if you have a Capital One in your wallet, they review your credit every 30 days, which means in the contract, in like the 4 font, the little itty bitty 4 font on page 28 of the contract that you didn't read, it says that we reserve the right to increase your interest if you become a higher risk to the bank. Meaning what? Meaning your credit score goes down. Well, they're in control of the credit score. They're the ones who report information to the credit bureaus, right? So, and I'll explain that why I say Capital One later, but they pull your credit every 30 days to reassess risk, meaning if your score goes down, they can jack your interest rate up. But never, ever during one of these routine account review inquiries, if your credit score has gone up, will they lower your interest, right? It just doesn't happen. You have to call them and beg and plead. So that's an inquiry that doesn't hurt your credit as well. So I hope that answers your question, ma'am. And then there's another type of inquiry, which is a promotional inquiry. These also do not, in theory, affect your credit score, but I've seen them affect your credit score. And this is like the you've been pre-approved, you've been pre-qualified. We've all gotten that in the mail, right? Like pre-approval letters from credit card companies or whatever. Well, how do they get your information? It's important to, again, understand Experian, Equifax, TransUnion, they're for-profit businesses, right? And they have a responsibility to their shareholders. And one of the ways that they make money is by selling your personal information. So, again, Capital One may approach Equifax and say, hey, here's $1 million check. Give us 10 million names of people that have, between a 600 and a 640 credit score. Well, why would Capital One target 600 to 640 consumers? Because they're irresponsible, but they pay their bills on time, right? So that's someone they're going to give a $2,500 limit to, and in that $2,500 limit, they're going to max it out in the first month, and they're going to make minimum payments for the rest of their life until they, until it's paid off and at 30% interest or something. So that's an ideal situation for them. But that's a promotional inquiry, you guys, the pre-approval thing. So, to get back to Dave's original question, though, what I'm looking at is I'm looking at all of these things, right? I'm looking at, are there excessive inquiries that can be removed? Are there medical bills and things that we can challenge for removal? Can they build positive open active credit? Do they have a good balance of types of credit? So we're looking at all of that, and then we're doing the legal review and so forth to figure out, okay, where is there an opportunity? How soon can we get them to whatever Dave's goal is, if it's 700 for a conventional loan, or if it's a 620 or 640 to do an FHA loan, whatever it is. So we'll work, and get an understanding from Dave or Maria on what they need for that particular file. And then we'll work with the consumer to figure out how we can, if it's possible, to get to their goal. So thanks for asking that question, Dave. What else, guys? What other questions do you have?
There was one question. Is there anybody behind me?
Yes.
Go ahead and take that one.
I have a couple of credit cards that I really don't use anymore. Do you recommend keeping them open and active, or if I close all of them, will that affect me because I have a less credit limit?
Great question. And it's not necessarily about having less credit, and thank you for your question. It's about your length of credit history. So that's one of the, I keep doing this thing with my hands. It's one of the components that I haven't gotten to yet, which one of the components is length of credit history. So it's 15% of the score is your average of all your open credit. So, I sounded like a creep a couple on various occasions. But I told one of the clients I was talking to go buy herself something at Victoria's Secret. And I thought she was going to jump through the phone and kill me because she literally took it the wrong way. But I had the best intentions for her because it was the oldest account that she had on her credit, which means it was open since like 1998. And if you guys look at your credit report, you'll see that a lot of times it says closed due to inactivity, right? Or closed by credit grantor, something like that. And the reason they do that is if you don't use it, they'll close it. And your length of history, you guys, is an average of all your open accounts. This is why you'll hear people like Susie Orman say, don't ever close a credit card. And she's right. You don't want to close something that you've had open for 20 or 30 years or something, because this section of your score, which is 15%, which is a big chunk, you guys, because the scale goes from 300 to 850. It's a 550-point scale. 15% is like 90 points, right? That's a huge deal. And if you close something, and to your question, you'll lower your length of credit history, especially if it was open a long time, right? So when I told this woman, I had to correct myself, and I kind of rambled back into it and said, they sell chapstick there. I didn't want her to think I was a total creep. I was literally had her best interest in mind because she was trying to. Can you guys see me? I'm here. Can you see me?
You're back.
Okay. She was trying to refinance, and had she had this Victoria's Secret card closed, I feared that it would have knocked her score down by 70 points, and it would have literally either killed the deal or it would have cost her, you guys. She was looking at getting refinancing out of mortgage insurance, which was like $322 a month, and she was in like a terrible interest rate, and she was in a situation where she could save, I think, a total of like $600 a month. I'm not even kidding. $600 a month over a 30-year loan, you guys, is like $216,000, right? So that's how powerful this stuff can be if, one wrong decision or wrong move at the inopportune time, because everything gets magnified with a home loan. The difference between a 679 and a 680 credit score could be, $100 a month over 30 years, which is a ton of money, right? $36,000 to be exact. So, everything gets amplified. So it's important to understand that. And thank you for your question. I would say don't close credit cards that you've had open for a long time. If you're going to close close ones that you've opened within the last year or two, right? Depending on your age and everything, because everyone's credit is different based on your actual age, but the age of the account is what's really important. So make sure that your average of open credit is as high as possible. So, and again, if you have a card that you haven't used in a long time, I recommend, if it happens to be a store credit card, a Victoria's Secret, Old Navy, whatever, go buy something silly there and then just pay it off to keep activity on it so they don't close it and you don't lose that history and have your credit score go down drastically. So,
Do you have a question?
Yeah. So say you've reached a point where everything's paid for, your house, your vehicles, and the only thing that you use your credit for is your credit cards. How do you maintain that? And say you pay them off every month.
So
How do you maintain credit score?
How do you maintain? Yeah, you have to keep, and that's great. A lot of people work or live off, the Dave Ramsey lifestyle, or they're fortunate enough where everything's paid off and they're living a cash lifestyle. But it's also important to understand that there are things in your life that are impacted by credit that you don't even think about. Car insurance premiums, your homeowner's insurance, which you keep those policies active. There's all sorts of little things that affect your day-to-day life and what you pay for things that's impacted by credit. So it's important to maintain your credit. So if you're in a situation where you're fortunate enough to have everything kind of paid off, what can you do to keep positive, open, active credit? Well, I always recommend keeping somewhere between at least one, if not two credit cards, and pay them off in full. That's fine. But it's important, and I'll talk about this too, it's important to sync up the dates of when you pay it versus when they report to the bureau. So it's a huge point that I'll get to in a minute. But it's important to maintain some form of credit, because maybe a great opportunity pops up, and there's an investment property like a multi-unit duplex that you could just pick up at a total steal and cash flow it and make $1,500 a month on it or something ridiculous. And you don't have the ability to access capital for that, and you don't have the cash to pay for the house for that investment property, and you need to leverage other people's money. Well, you always want to be in a position where you have access to your credit, right? Where you can jump on an opportunity if it presents itself or whatever. So I always recommend keeping a couple credit cards open and active, put a tank of gas on them, pay them off in full, do whatever you need to do. So if you are fortunate enough to be in that position, that's what I would recommend, is just to keep some form of open active credit going. So, and let's talk about what I was just mentioning with credit cards. Is it's not about, like I learned this the hard way, you guys. So I owned, my first property was this little bungalow in Northwest Denver, and this was back in 2007. I bought it, and when the lender pulled my credit, I had like a 711 or something credit score, and I was just dumbfounded because this is what I do. I'm the credit stuff. And so I'm like, 7-Eleven, if anyone should have an 800 or whatever, it should be me. I'm obsessed with the system. I'm obsessed with making sure that I understand it. And I didn't know what had happened. But at the time, I was traveling all the time. I was coming up to Kalispell or Whitefish, or I was, driving around, going from Helena to Billings, or I was out in wherever, in Indiana. And I was doing seminars for real estate agents. And I was traveling, but I had a Wells Fargo Visa that I was using at the time. And it had a $3,000 limit, and I was maxing it out every month on business travel, and then I was paying it off in full. But what I didn't understand is that every credit card company, so think of the credit bureaus as a swimming pool, right? They're just a hole in the ground, and all the information, all the water inside that pool is your creditor data, right? So collection accounts, car loan, your mortgage, anything, right? All the stuff that's on your credit, that they dump that bucket in once a month and update the credit bureaus. Well, when your report gets requested by Dave or whomever, whatever information's in the pool at that point in time gets siphoned out and run through the mathematical equation to calculate a score. Remember, I mentioned you get 100 different places. They're using 100 different calculators to calculate the score, and that's why it's different, even though the information in the swimming pool is the same, right? So what I found out is Wells Fargo, so if I asked everyone in the room, when's your credit card bill due, and all of you blurted out right now when it was, you aren't going to say the same day, one of you is going to say the 12th, one of you is going to say the 6th, one of you is going to say the 24th, whatever. The point is, you guys, your credit card bill is due randomly based on when you open the account. That's your statement cycle date and your bill due date. All the credit card companies report on one random date throughout the month, right? So let's say Capital One, for instance, or let me just stick with my example. What I found out was Wells Fargo was reporting on the 15th of the month, but my bill was due on the 17th. You see where I'm going with this? So every month I'm running it up like $2,912 was my balance on a $3,000 limit card. Well, that's bad, you guys. Ideally, you want to be at 20% of your limit or less, right? I used to tell people 30, but I'm noticing that it's kind of trending towards 20% now. But at least below 30%. So if you've got a $1,000 limit on your credit card, keep your balance below $300 every month, and you should be good, right? And it's not cumulative, so it's not on all the different cards. It's on each individual card is how it works. So if you're struggling with credit cards or you're trying to figure out, hey, I got to get out of credit card debt or whatever, you want to put your money in the places that is going to reduce the balance to limit ratio. So start with, for instance, if I've got a $300 limit on a card and you've got a $3 million limit, if my balance on my $3 limit is $2.90 and yours is on your $3 million is $2.9 million, we have the same balance to limit ratio. It's affecting us the same. You follow me? Whereas me on my $300 limit card, I would only have to come up with $200 to get below 30%. You'd have to come up with $2 million to get below. You see what I'm saying? So it's all about the ratio of utilization. So focus on the smaller balance, smaller limit cards to reduce the utilization. But back to my original point, Wells Fargo reports they dump that bucket. So me and 10 million other credit card users' data gets dumped in on the 15th of the month. My bill is due on the 17th. So even if I pay it on the 13th, they'll show on the next statement, the payment was received on the 13th. We posted the payment on the 17th, right? So, and I learned this the hard way, you guys, because it literally cost me $300 a month on my mortgage if I didn't figure this out and fix it. Because that 711 versus 740 credit score, the difference in the interest rate and the lender credits and everything that I could get, it equated to about $300 a month. And it was ridiculous. It was $3,600 a year over 30 years is $108,000. And that's what this 5-minute phone call to Wells Fargo led me to understand. So what I did was I changed my bill due date from the 17th to the 13th. So every month my payment posted. So when Wells Fargo dumped the information for me and 10 million other credit card users on the 15th, it showed me with a zero balance or very close to it. My score, you guys, went from 711 to 806. 5-minute phone call. That's how powerful this stuff is and why you need to understand it. Credit card bills, so even if you're using it super responsibly like I was in this instance, some of us aren't. Some of us are just making minimum payments. We're in real estate, we're waiting for deals to close, whatever. That's okay. Still do this. Why not show the smallest balance you carried throughout the statement cycle? Follow me? So I hope that makes sense, you guys. I hope I explained it well enough to understand, but it's a very powerful example. So, and I've told countless people, thousands of people to do this, and they've reaped the benefit of it since I've learned that. So go ahead in the back. I see a question.
Yeah, can you talk about student loan debt? We don't have any credit card debt in my family, but I married somebody who has a doctorate, and we're talking like close to $300,000 in student loans.
Yeah,
and, you would pay like minimum payments, or how much more we should be paying to like get our credit to where it needs to be?
Installment accounts, and that's a great question, thank you. Installment accounts, you guys, don't impact the same way as revolving. So the stuff that I'm talking about as far as balance to limit ratio on things is revolving debt. So the only two things that fall under revolving would be credit cards or home equity lines of credit. So if you have a HELOC, a home equity line of credit, it's important to understand that it impacts the same way, as a credit card. But when it comes to student loans or auto loans or personal loans or things that are installment forms of credit, meaning you have fixed payments, all that matters is that the payment is made on time. So as long as you're making the minimum, you're doing the best you can. It's not going to make a difference if you pay them 2,000 times what the minimum payment is 1 month. It's not going to necessarily impact your credit score. So with installment forms of credit, it's just important that you keep them current. And I wrote a book recently, you guys. If you're on Facebook, if you're Facebook users, if you check out the Credit Movement, I do these daily credit minute videos. But I authored a book called The Movement. And in the book, I talk about student loans. I talk about income-based repayment plans, forgiveness plans. And I give over, I think there's about 30 different sample letters with all the legal jargon to remove things, whether it's an eviction or charge-offs, collections, repossessions, foreclosures, and the law behind that. So the book is a really, really good resource for any of you guys that have family members or something that may be struggling, because I walk you through, and I have all these online courses that you get access to as well, where I walk you through step by step how to use those different letters and so forth. So check out The Credit Movement. If you go to thecreditmovement.com, that's the website, and you can click the get the book or get started. There's a free course on there for all of you guys that are here today. If you go to thecreditmovement.com/special, you can get access to a free course which shows you how to correct names and aliases, dates of birth, socials on your credit report to make sure all the foundation of your report's accurate. But I also give 2 different letters to remove all the inquiries from your credit report, which, you guys, if you did anything within the last 2 years where your credit was pulled, those inquiries are affecting your score. So check that out. It's totally free course. So I did that, for you guys that are here today. So I hope I answered your question about student loans. I know that, there's tons of people in our country right now. It's a big thing. It's in the news a lot. They're talking a lot about student loan debt. But to be honest, if you're making your payments on time, that's the best you can do. There's no benefit to necessarily paying more. As long as you make at least the payment each month on an installment account, you're good. It's the same thing with a car loan. If you have a car that your payment's $200 a month, if you pay $600 a month, it's not going to help your credit score in any way. So
We have another question here.
Yep.
Hi, Brian. I just want to thank you for the information that you're giving. It's excellent. Have you thought about going into schools, high schools, and teaching these young kids how to use credit?
I would love to, and thanks for bringing that up. I actually I went to school in Wisconsin, University of Wisconsin, Oshkosh, and I wrote to some of the professors there, and they welcomed me. I just haven't made it in, and I'm passionate about doing it. I question the kids, understanding of it. These damn millennials. I look like I'm young, but I'm 38. I feel old. I don't know whether they'll understand it or grasp it, but I think it's important information. I always tell people you could get a doctorate in finance, and they won't teach you the stuff that you're learning today because nobody really understands it, right? Fair Isaac kind of keeps this a hidden recipe. Their algorithms and the laws are kind of ambiguous in the way that, it's hard to understand them. And so, yeah, I think that's a great question, and it's something that I'm certainly passionate about. And it's kind of why I started the credit movement on Facebook. I've gotten about 15,000 organic followers just by putting, me holding my phone like pretty much the angle that it's on right now, and teaching people just through daily credit minute videos, little things, 1-minute little tips. So all the stuff that we're talking about today and much, much more is on that page. And I'm trying to get the information out there the best I can to do my part, because I've been obsessed with the system and trying to educate people. I'm doing the best I can to spread that, but I think I could do more in that sense of trying to get into maybe seniors in high school and early college to help them understand the importance of credit and the foundation that it provides for your financial future. So, but thank you for mentioning that.
Hey Ryan, we're getting close to the end, and there was one big one that I wanted you to address. So a lot of this stuff's been like, how to make it better and all that. If you just blew it in all ways, and you're just sitting there with your head in your hands going, man, I'm never going to be able to, I ruined everything, and that's like where you're at right now. Can you just give some guidance, like how do you get out of that situation, and how do you get where you need to go, like after just horrible credit trauma, and you want to have a hope for the future? Can you just kind of maybe speak a few minutes to that? Like what should you do? How do you proceed so that it's not a permanent situation?
Yeah, no. There's a lot of people that, are in survival mode, so to speak, is how I put it a lot of times, because people go through terrible situations, whether it's an ugly divorce or, job loss or medical issue that comes up in family or to you immediately, so these things happen, and maybe you're in a situation where you're just, I don't know where to turn. I don't know what to do. And I always tell people, bankruptcy is a scary word, but it's not the end of the world, and I've advised more people into bankruptcy than I care to share, because I'm not going to tell people. I've never been the guy. I wouldn't be in this. Credit repair, so to speak, has kind of a terrible reputation. because there's a lot of scumbags out there that like advertise on Craigslist or the side of the freeway, and they just tell people I can get you an 800 credit score overnight or something. And I've never been that guy, and if I were, I don't think I'd still be in business. But you know, I don't want to give people false hope. So I want to tell people realistically, like, hey, this is your pathway out of what you're feeling right now or the situation that you're in. And so I've always shared with people, you know, honesty in the sense that, like, hey, here's what we can do given your set of circumstances right now. Here's how we can get you to your goal as quickly as possible, the way that I see it. And I've told people, like, you know, I've seen people file bankruptcy today, and 2 years later they're buying a house, you know, because we've rebuilt, we've reestablished credit, and we've put that kind of bad period behind you. Everyone goes through things in life. You don't have to be. I always make people understand that they're not alone. You know, millions and millions of people are filing bankruptcy. I mean, if you're in dire straits, I always say if you don't see in the next 2 years that you're going to have in cash in your hands 50% of what your total debt obligations are, outstanding in collections, I mean collectible debts, then bankruptcy is something you need to be considering. Because with 50% you can settle and you can do things. But if you don't even see yourself having 50% of what your outstanding collections and debt obligations are, bankruptcy is something to consider. So, you know, if that's the situation as Dave described, that you're in desperate, dire straits, it's not the end of the world, because I've seen people with 700 credit scores and buying houses 2 years later. So I don't think it's the end of the world. And there's always a solution. And oftentimes, you know, I definitely advise people or take people on as clients or help people much more than I advise them into bankruptcy. But I'm just mentioning it here because it is something that I've told thousands of people that it's something to consider. But there's always a pathway out, you know, so I'm always going to look at it and help people prioritize, you know, hey, you have X amount of cash available. Here's your situation. Here's the debts you have. Here's what's impacting you the most. Let's prioritize what we need to target. And we come up with a workable solution with action items to get them to whatever their credit related goal is. So what else, guys?
Yeah.
I see a question there in the back.
Well, that was
Oh.
my question, so I kind of want to clarify, because what if someone's made a few small mistakes? At what point do those fall off? Do they ever fall off? 7 to
Yeah.
10 years?
Great question. So there's two important dates you guys to understand. There's the statute of limitations of how long they have to sue you for the debt. I'm not sure in Montana. I think it's 4 years though, of how long they have to sue you. I'll have to look. But most states it's 4 years of how long they have to sue you for the debt, meaning they can garnish your wages, things like that. But in every state, federally, it's 7 years is the statute of limitations of how long something can report to Experian, Equifax, and TransUnion. So, great question. I think the gentleman
Okay.
on
Yeah.
the left side of the room there. Yeah.
Yeah,
Go ahead, sir.
go ahead.
Bills that we were handed say that we should make sure our credit card company reports a limit. So a twofold question: how do we determine if that's the case, and if it's not being reported, how do we change that?
Yeah. So obviously, get access to your credit report first. They'll sometimes show it as high credit, or they may phrase it as high credit, just so you're aware. It may not say limit, but look at what the high credit or the limit is. If it's blank, that's a problem. And that kind of what I was mentioning, why I referenced Capital One is something they were notorious for in the early 2000s was, as I mentioned earlier, they're the ones who dump the bucket in the swimming pool, right? They're the ones who report the data to the credit bureau. So they're the ones in control of the credit score. Well, remember their big advertising campaign, for those of you that are old enough, back in the early 2000s, they exploded on the scene. They became one of the biggest banks in our country, right? Really quickly, because they had super aggressive advertising. Remember, it was like David Spade with the Viking hat on and what's in your wallet. And, you know, their big thing was the campaign that they ran on was 0%, no hassles, no haggles for 1 year. Remember that? 0% interest, no hassles, no haggles. That was their tagline. And what they figured out was they could lure in a lot of people with this pretty little offer, but then they realized that they're in control of the credit score. So they said, you know, we can leave the limit field blank, and whatever the high balance is will default as the actual credit limit. So let's say you get approved for a $3,000 limit, but you only use $222. You put a couple tanks of gas in your truck. Well, that $222 now defaults as your high limit, your high balance and your limit, and it's also your balance. So you're 100% maxed out. Well, that murders your credit score, right? Your credit score goes down. Now they jack your interest rate up to whatever, 30% interest. Even though, and you call and you say, hey, I was told it was 0%, no hassles, no haggles. Well, this is a hassle. This is a haggle. What are you talking about? And what you find out is that they say, well, unfortunately, sir, your credit score has gone down, and during one of our account review inquiries, like we talked about earlier, we've noticed your score has gone down. You've become a higher risk to the bank, so we reserve the right to increase your interest, right? That's the game that they're playing, right? And it sounds illegal as hell, and it is. And there's class action suits and all that stuff. They don't necessarily do it anymore, but there are still companies that don't. That there's accidents that happen. Not all the data gets transferred. So to answer your question, sir, check annual credit report. Don't get the score again, just get the report, and make sure that the limits are reporting. And if they're not, you need to phone them immediately and request that they report a limit. And the 20-year-old in the call center that picks up the phone that doesn't know what you're talking about, you're probably going to need to ask for a supervisor. You can also write a letter, and that letter is available. A letter about that is available in my book, and in the document vault on the online courses that I provide through thecreditmovement.com. So that's a good resource for you guys.
Ryan. Hey, I just want to let everybody know that we are going to have Ryan get all your emails, and then he will send you an email out so you can contact him as a follow-up if there's, I know you had a question, but we could go on forever on questions. But you'll be able to ask him, Ryan, so we'll get you that list hopefully before the end of the day so you can just do a quick follow-up. And
perfect. And yeah, I'll send you guys an email just so you have all my contact information, and I'll send you links so you have access to those the resources that I mentioned as well that could be beneficial to you guys. And feel free to email me anytime with any questions you have. I know sometimes this isn't a public forum. It's being broadcasted on Facebook too. It's not the easiest to talk about. Maybe you have something that's irking you or a family member that you want to talk about. So we can talk about that privately as well. So thank you guys for your time. Thank you, Maria. Thank you, Dave, for inviting me. And I'm glad the technology worked out. I'm glad I was able to spend some time with you guys this morning. So thank you very much.
Yeah, so did you have something real quick?
I just want to thank you all on behalf of the chamber just for taking the time to come out and sponsor and bring lunch or breakfast and give us the eye-opening information. I think we all benefited from all that.
Yes,
so
thank you
for your
And
time.
I just wanted to point out, so with Ryan and his business, we're not in any way related other than the fact he really benefits me. And so he kind of has had two different services that we've recommended to clients. We've had some clients give them their credit report, and he'll give them kind of like, here's what you got to do to get where you need to go, and you pay a fee for that. And I think it's very reasonable. I'm going to let him, when you guys engage, if you want to engage him privately, that's a service he provides, and it's not predatory like a lot of other companies. It's why I recommend. And then he has like a monthly option where you can like engage in a relationship where you're doing all this stuff and they're monitoring and everybody's aiming for a goal, and then you cancel it when you get there. And I just think compared to what you see out there, he's doing a really good job. You've seen him answer your question. So when he reaches out to you, just you'll have the information, and he can privately do that. But I found as a mortgage broker that if I get somebody to take him seriously and do what he's saying, they might come back to me as a mortgage client, which is what I'm interested in, and that's better for them, compared to them going to some, company that like takes thousands of their dollars and doesn't deliver results. And then also like there's like people trying to do it themselves. You heard how complicated this is. I'm in the mortgage business for 12 years, and I've determined that if you got a problem and you really need to get out of the problem, unless it's just like one thing on your credit report, but if you got stuff, you need some help. So just consider that.
And there's so many catch-22s to it, Dave, as well, right? You think you're doing the right thing, and you end up shooting yourself in the foot. There's a lot of catch-22s. Paying a collection will reset the date of last activity and lower your score. Most people are like, well, That's not how it should work. You know, I'm doing the responsible thing as a consumer, and you pay a collection, reset the date of last activity, and your score goes down by doing that. So there's just so many things so I'm glad you brought that up, and thank you guys so much for having me, and thanks again to Blackstone, or Black Diamond rather, and I really appreciate your time this morning, everyone there. So thank you.
All right, thanks.
Thank you.
We'll be around for a few minutes, so thanks again. Oh, and I didn't mention this in the presentation, but you did. So this was Ryan's material on how you're